Fitch upgrades the viability of ratings of 5 Philippine banks, namely BPI, BDO, Development Bank of the Philippines, LandBank of the Philippines, and MetroBank. With us now for more, live from Singapore, is the director of Fitch Ratings Financial Institutions, Tamma Febrian. Good to have you with us, Tamma. Welcome to the program.
Hi, good to be here, Kathy.
Well, it's certainly good news amid all the uncertainty, though consistent with the improving Philippine sovereign credit ratings in recent years. What were the reasons and the metrics for the upgrades?
Yeah, so what drives the upgrade on the bank standalone ratings is driven by our a more positive assessment of the banking system operating environment. And this takes into considerations the country's strong economic growth prospects, with GDP expected to rebound closer to 6% over the next 2 years. And we also take into consideration the resiliency of the bank borrowers, as well as the bank-owned credit standards, which should keep impairment risks relatively manageable over the next 12 to 18 months. So I think this supportive economic condition will continue to bode well for loan demand as well, where we would project the loan growth to be relatively brisk, at 12 to 13%. And profitability should also stay whole, given the prospect of a shallower and a slower rate cuts, which would be positive for the bank margin. So all in all, it's really us trying to recognize some of these improvements and also the relatively good prospects of the banking system.
Right, certainly some good news there. But how come Fitch's credit ratings are the lowest for the Philippine sovereign government when you compare that with Moody's and S&P? Because Fitch is at BBB minus and Moody's is at a notch above the minimum investment grade, or a notch higher than Fitch, versus S&P, which is a BBB plus, or 2 notches higher.
Yeah, so I can't really comment on the sovereign rating, nor can I comment about the other rating agency methodology. But what I can say is that we believe that the recent upgrade on the standalone credit ratings is what will make it a little bit more consistent with what we have rated with for the bank peers in the regions. No doubt there's a lot of structural improvements in terms of profitability as well as the capital buffer since the pandemic levels. But I mean, if you take a look and compare with some of the larger peers in Indonesia and also some of the leading ones in Thailand, I think Philippines still got quite a bit of a catch up in terms of profitability and capitalization. So, but this is not to say that there's no prospects for further upgrade over the medium term. No, if things continue to they continue to do well and they can actually do better, then of course they will create an upward provisions in their standalone credit ratings.
All right. Well, we hear you. Thank you so much, Tamma. Such great news to end the show. Tamma Febrian of Fitch Ratings in Singapore.